All right. Welcome to Housing Bubble 2.0 News of the Week. I'm Randy Patrick, here to provide you with the real estate news you need to know to make those informed financial decisions for your future. Well, listen, this is après Thanksgiving, I guess we'll say report. Didn't do one last week. Everyone was busy. I figured, we're doing family stuff. And again, I hope everybody had a great Thanksgiving week off, spending time with family, friends, loved ones, etc. It was a bit of a quiet week last week, but let me tell you, things picked up this morning. And, I was actually going to do a video yesterday, but I thought, you know what? It's Monday. Let's see what the news brings the next day. And I'm glad I did. I waited because we got a lot on the go today. So listen, we're going to talk about what's going on in the local markets, home builders coming clean, NAR, which is National Association of Realtors Cry Uncle, borrowers flock to arms, and Amazon is already priming their HQ2. So here we go. But first of all, this morning, the most recent Case-Shiller National Home Price Index came out. It was released, and I guess you could say this is for September, and home price gains shrink to the lowest level since January 2017. So basically, the prices increased 5.5% annually as compared to last, I guess you could say, compared to this time last year, which is down from 5.7% in August. So we are definitely seeing a slowdown through the Case-Shiller indices right now. Obviously, this is their top 20 index. If you go deeper into the Case-Shiller, you can actually investigate city by city and really take a look at what your local market is doing. But for the purposes of our discussion, I basically go with the National Home Price Index. It's published, kind of gives a good litmus of what's going on in the real estate market. So basically, again, real estate values are still high, but they're shrinking. So the amount of appreciation is shrinking. In many locations, it's plateaued, and we're seeing a lot of different changes now in the marketplace that's going to affect us as we go forward. So that's the scoop on that. So with local markets, okay, existing home sales, so according to National Association of Realtors, the existing home sales transactions were up 1% last month, which, that happens when more inventory comes in the market. It frees up more opportunity so more buyers can jump in and actually purchase property. Not surprising. Clearly, the sentiment is is coming on the market, which means buyers are having a lot more choice now, and that's going to result and is resulting in pushing down of prices. So I'll give you some examples. Naples, Florida, they say they have 7.5 months of inventory. Single family residential under $300,000. Listings grew by 79% in October. So again, that's sort of affordable housing, grew by 79% in the amount of listings in that area. Dallas-Fort Worth, number of pre-owned homes. Sales are lower than a year ago for the third month in a row. So the volume is or the actual returns are coming lower and lower now. According to CAR, California Association of Realtors, the sales to listing price ratio has hit its lowest point in 20 months in October. And again, I'll explain this. So if you're a real estate professional, you put a listing on your local MLS, and my listing, say, is $500,000. Well, if the actual price, the purchase price, the buy price is, say, $490,000, then there is a ratio of my sold value to my listing value. So people look at that as a testament to say, hey, are you a good real estate agent? Do you know where to price your properties? If that delta, if that difference between sale price rate and listing price ratio is very large, that means your real estate agent really is pie in the sky, sort of reaching for numbers that don't really exist, and the listing price is more of what the market is dictating these days. So, but the whole point though is that listing price ratio is at its lowest point, which means there's a divergence in price point that's listed and price point that's actually selling. Of course, more buyers coming on board, wanting better pricing, more negotiation, higher interest rates. They need to get more out of the property to compensate for the higher rate. So we're seeing that right now. Orange County, California, supply of homes is up 53%, which is huge, and builders have 35% more of unsold new home inventory than they did before. The days on market are doubling from the previous year's days on market in many SoCal locations, or even tripling or more than that. Active listings in San Francisco, San Mateo, and Santa Clara counties surged by 76% compared to last October. Price cutting on listings has quadrupled from previous October as well. King County in Washington State, so Seattle and Bellevue jumped 91% compared to last October. Again, that was listings put on the marketplace. They jumped 91%. That's huge. And again, price reductions have more than tripled since last October. Hawaii, we don't talk too much about Hawaii because it's kind of out there on its own, but Hawaii is traditionally an expensive place to buy real estate. Well, Hawaii's dropped 25% over the past quarter. And also Detroit, also quiet in Detroit these days. The Detroit housing boom, sales have dropped about 9% last month. And Detroit has sort of been a more economical place to purchase property in the U.S. But again, every local metro has their highs and lows and has their, I guess, microcosm of what's going on. So they've dropped 9% last month. So there you go. So as a housing sentiment, more inventory, a lot of price decreases, a lot more listings are coming on the marketplace. Sellers are obviously getting scared, nervous, anxious. They want to get their property out there. So there's a chance they can get their hands on that equity that they've amassed over the past couple of years. And this is how everything starts, is that you put your property on, then I need to put my property on, but I have to cut mine a couple points lower than yours to get buyers and get looks, etc. That's how it all begins, folks. All right, home builders come clean. What I mean by that is housing starts rose 1.5% month over month. Permits fell just under 1% for month over month. That's lower than expected and projected. According to some of the reports that the home builders have finally embraced reality, and the National Association of Home Builders, their optimism, the sentiment index dropped from a score of 68 to 60 in November. It's the biggest drop since 2014, lowest level since 2016. Clearly, it's the demand for new housing is stalling. Now we see home builders who are offering major incentives to sell their inventory. We are seeing huge price discounts. I saw some reports of some locations in Southern California offering $100,000 off the price. They're offering, obviously, upgrades to the finished material, to the features of the property. They're obviously offering real estate agents trips and extra commission to bring their buyers and send their buyers to come in and take a look and purchase a new home. So they're doing all those things to basically deal with their inventory and try to sell it. So again, having a house that's you bought the land, you've built it, you've paid the workers, you've paid the material, sitting there doing nothing doesn't make sense. They just want to move that property. Now the people, funny enough, are still hesitant. Why? Because they're of the point and the state of mind that, well, how much more can I get? And also realize this, that say you're wanting to buy a new house, and all these incentives are loaded up for a builder to say complete phase 1 or phase 2. Well, once they do that, they're going to open up phase 2 or phase 3, and typically what happens is that those prices in this kind of market, in the downward market, are going to be reduced and be less than the phase 1 pricing. So people are kind of hesitant. They want to see what's going on and how much more they can get off the purchase price, which is the smart thing to do, of course. Now, NAR, National Association of Realtors, Cries Uncle. What I mean by that, there's a guy called Lawrence Yun. He's the chief economist for NAR, and he stated, and I actually printed this out so I could actually read it to you. He said, rising interest rates and increasing home prices continue to suppress the rate of first-time home buyer sales. The home sales could further decline before stabilizing. The Federal Reserve should therefore reevaluate its monetary policy of tightening credit, especially in light of softening inflationary pressures, to help ease the financial burden on potential first-time buyers and assure a slump in the market causes no lasting damage to the economy. So what this guy is asking for is the fact that the Fed loosen their credit policy, so make it easier for people to get loans. And this is what it boils down to. It's money chasing homes. That's the problem we have now. So the federal government already is endorsing 3% down loans. So even though interest rates have risen, to offset that, they're saying, okay, well, even though we're raising rates, we're going to make it easier for you to get a loan, to buy that house, even though you may think it's out of range. It's not, because your down payment requirements are 3%. You see, so that's the offset there. So, I don't know what else they can really do. To me, that's not a smart move. It's not, but again, the mortgage people will come back and say, well, these are still qualified borrowers. Yeah, but if you're qualifying borrowers for high limit mortgages with 3% down, as we always say, there's a 5, 6, or 10% shift in the marketplace, they're already underwater again, which is not smart. So please realize that this is going on. And again, so he's basically asking the Fed, saying, hey, help us out here, guys. And also, one more thing, he was quoted this past week. He's out and about these days, and his situation is that, how he's addressing the situation in the housing market is he's saying to people, hey, instead of paying attention to the accumulating debt that we have, because we're now as a society, we've maxed out in our debt, whether it's mortgage debt, whether it's credit card debt, student loan debt, auto debt, whatever the debt is, we've got the most debt than we ever have, and it's more or just as much, if not more, than we had the last housing crisis. So he basically is saying that don't pay attention to the accumulation of debt that we're doing, but we shall be focused on assets. So focus on the assets. And I kind of wonder, gee, what kind of asset is he thinking of? And he says, look at the combined net, and that indicates that we have a strong household balance. So, for example, if your mortgage is $400,000 and you owe $50,000 on credit cards and student loans or whatever that is, and your home was worth $500,000, I guess on your household balance sheet you're positive $50K. Well, that's not particularly a comfort. So this guy is basically saying, hey, don't worry about the obvious debt. Go buy that high price house. Let's have the prices increase, because you know what? This is your balance sheet, so the net effect still shows you being positive. Well, that only works in an appreciating market. And I can tell you right now that we're not appreciating, or our appreciation is slowing, it's plateauing, and it will start to slide. That's what's going to happen. It's very obvious. I'm not the only person that says this or talks like this or thinks this, so please be aware that this kind of is really a false statement, and it's one of those things where it's people are kind of trying to pull whatever they can out of what to kind of candy coat the situation. Now and also one point I want to make about this, which this came out the other day as well too, is that NAR, the National Association of Realtors, is approaching a record number of real estate agents that are part of their association across the U.S. They're at roughly 1.367 million realtors across the country. So clearly, Lawrence Yun of NAR needs to say these things to support, his people and the people that are paying $99 every year, if not more, to NAR they're bringing deals in, they're taking courses, they're becoming real estate agents, they're doing deals. Maybe one deal, 100 deals, who knows? But they're involved. But boils down to he's perpetuating his income stream and his, I guess you could say, colleagues. There's nothing wrong with that. But I have to laugh and go, well, listen, the statements he's making aren't necessarily realistic for everybody that's out there. Okay. Now, I think this is damage control, and if they would look at the damage control, they would actually need to go back, 8-10 years ago to see what really happened and prepare their flock for that. Now, again, I'm also a licensed real estate agent, a licensed broker, so of course, I listen to this. I don't agree with what he's saying. I know what's going to happen, and I've been through it once. I prepared myself and am preparing myself for what's going to happen in 2019. So there you go. Borrowers are flocking to ARMs on a different note. So basically, what was the main mortgage issue that kicked off the last housing crisis? Well, it was subprime loans, and those subprime loans had adjustable rate mortgages that reset, and unfortunately when they reset, guess what? The value was too high for people with fixed incomes to pay. They couldn't handle those increases, so guess what? We started the housing crisis, the first one, okay? So guess what? ARMs are increasing in popularity, so they are growing. Percentage of ARM mortgages rose from 7.2% of all loans to 8.2% from September to October. Home buyers are trying to use these to get into the lower rates now so they can afford their homes, and they're gambling that the rates won't go too high in the future. So we know that the Fed has already said expect a December rate increase, expect 2 to 3 rate increases in 2019. So people are going to go, okay, for me to get into that house, to money chasing the property, I need to get a loan that's going to work for me. So subprime can work. 3% down can work. Now the ARMs are coming back. So it's almost like the loan products are reversing. We had the issues, we had ARMs, HELOCs, conventional issues, the whole bit down the road, loose credit standards. Now we have higher credit standards. And, as a result of that, now the higher credit standards are being loosened, and more of these loans that initially started off the last housing crisis are coming back into play, which is kind of interesting. So deja vu, people. We're walking into this with eyes wide open. It shouldn't be a surprise if there are any issues in the future. I don't think we can point the finger at anybody but the central banking system, the Feds, Fannie, Freddie, the mortgage people, whatever. I mean, they're perpetuating this purchasing, this frenzy. And this is really, it's speculative. That's what it boils down to. It's going to go up. You're not actually, some of the problems, the last housing crisis, you had speculative investors thinking, I'm going to buy it for 100, it's going to be worth 150 next year, whatever the number is. Well, now you've got a government and these large, national organizations doing the same thing, but they're speculating on a higher level, a much broader scale, with a lot more people and a lot more money. So that's the scoop. So they expect that they're going to see more and more increases as the years go on. And I'm afraid we've tapped out. That's not going to happen. Things are changing. It's right there. It's in front of our eyes. Okay. So again, betting back that ARM rates and rising property values have peaked is kind of risky. I wouldn't want to bet against that. All right. Another note here, Amazon. I say Amazon is priming with the HQ2. So of course we know that Amazon had announced 2 new headquarters, I think one in Virginia and one Long Island City, which is, I guess, the Queens part of New York area there. And basically, of course, that area now has had a surge of interest since Amazon decided to put its headquarters there. There's way more real estate sales activity in the past 2 to 3 weeks. Open houses are apparently like madhouses, according to some of the realtors there. A lot of tax incentives are given to Amazon to relocate or to locate their HQs in those locations. But the whole thing, though, is I'm not too sure whether all these new employees will be able to afford those homes or not. So you're going to an area, it's the Amazon, I guess, prime push as far as I'm concerned, where you're probably going to see some short-term increases in value. But the people who are either relocating there or going to live there, that are going to work at Amazon, I don't know what the pay structure is. I mean, I know what the pay structure is for some people that I know that are Amazon employees down here, and it's not like you can, you're not making a 6-figure income and you're going to support all these great high expensive properties. It's not going to happen. So not sure how that's going to roll out. It's going to be interesting to find out. And again, some of the local people are upset at all the tax breaks that Amazon is getting to put their headquarters there, stating the fact that they need the money to fix the aging roadways, the subway system, things like that, things that normal people need to commute to get around town in that area of the country, which seems to make a lot of sense. So that's the scoop here, guys. So lots are going on right now. I listened to kind of a video and an article just before I came on the video here, and the sentiment was the bubble is popping. So we peaked essentially in July. We're probably going to show maybe a little bit of peak when I see the chart for the Case-Shiller, but I think we're there, guys. We are there, and now the bubble is popping. You're going to see it. It's popping in other locations, the large metros, the places that had the big appreciation, like the Seattles and the Bay Area of San Francisco, all that area. We're seeing a lot of, the inflection points has reached. You're going to start to see a lot of things happen. And again, we're not seeing 5% or 10%, increase in listings. We're seeing 50%, 60%, 70%, 90%. I mean, we're seeing massive numbers increase. Where I am in Florida right now, I just pulled stats today. So oddly enough, we actually had a positive October. We actually did well in the state and my local area here. But when I looked, but again, that's a bit of trailing information. When I looked at the amount of inventory that's come on, we've got a 20%, around the Bay Area of Tampa here, increased inventory that's come on our marketplace now too. So it's starting to hit where we live down here. So again, your individual metro could be different. Others are going to move faster. Others will be more dramatic. Clearly where there's the highest appreciation, the minute there's a downswing, it tends to be a lot more, I guess you could say, extreme and obvious. So, but just look forward to that. And again, your location, it's coming, folks. It really is. I'll try to do more information in the future, but more of the metros. But we're seeing a lot more information now. So the social movement of the housing bubble is happening. People are talking. People are sharing information. We're seeing it quicker. We're seeing it happen a lot faster. And we are much more aware of it than we were back the last time around. All right, guys, thank you once again for viewership and subscriptions and your comments. Do appreciate it. We look forward to speaking with you probably at the end of the week. Thanks a lot.